Hi, today we will be discussing Chapter 6, Merchandising Operations and Internal Control, focusing on Objectives 5, 6, and 7. In Objective 5, we will focus on defining internal controls and identifying the 5 components of internal control and explaining and providing the 7 examples of control activities. Internal controls are the policies and procedures that management uses to ensure the following 3 objectives of a business. First, they must ensure through their internal controls the reliability of the financial reporting. Second, they must ensure that the business is in compliance with the laws and regulations for that industry. And third, they must ensure the effectiveness and efficiency of operations. In order to achieve these 3 objectives, there are 5 components that make up internal controls for a merchandising business. The 5 components of internal control begin with, first, controlling the environment. That's when the management of the organization needs to control the overall attitude, awareness, and actions of management and employees to ensure the integrity and ethics, and that there is a philosophy, operating style, organizational structure, authority levels, and personal policies and procedures in place within the organization to ensure an effective internal control environment. The second component of internal control is risk assessment. This is where management and employees within the business must ensure that they can identify areas of high risk that need controls, and then establish a means to address those areas and ensure they're in compliance with control features. Third is information and communications. Again, management must ensure that there are systems in place that are clear and specific to all individuals within the company relating to inventory operations. This means that there's policies, procedures, and mechanisms to ensure the information flow and communication are in place relating to addressing any types of merchandising and inventory issues. Fourth is ensuring control activities are in place. These are the policies and procedures to make sure that directives of a business are carried out properly. And fifth, there must be monitoring. Monitoring is just simply a periodic review to see if policies and procedures are being followed. Let's discuss internal control activities in more detail. As indicated, control activities are the policies and procedures to make sure that directives of the business are carried out properly. First, the first type of control activity is authorizations. Authorizations are putting in place who is authorized to handle certain types of transactions. Second, recording transactions, ensuring that transactions are properly recorded so that they enter the financial statement information correctly. Third is putting in place documents and records. This is using proper documents to make sure transactions are accurate, such as pre-numbering items, such as checks being pre-numbered, or purchase orders being pre-numbered, or invoices being numbered. Fourth is putting in physical control processes, meaning limiting access to various different merchandise or documents and records, and only allowing authorized people to access these items. Fifth is periodic checks of records and assets, for instance, by independent parties, such as an auditor or an external audit firm. Sixth is putting in place separation of duties, meaning that no one person is responsible for too many things. Separation of duties is a very key component of control activities. It's important in order to establish sound internal control, because a person who combines the responsibilities of record keeping and operating a department and managing assets would be able to misappropriate assets without detection. So management must establish proper separation of duties to ensure that no one person can improperly act without it being detected by other parties. A typical internal control procedure might be establishing a process where the parties who receive in cash are not the same people who deposit that cash into the bank. And lastly, seventh, sound personnel procedures, meaning that employees might experience job rotation to allow for rotation in employees between different positions to ensure that no one person is doing something inappropriate that couldn't be detected. Bonding employees, this is basically just a form ensuring employees who might be handling large financial transactions, and then also background checks before employees are hired to ensure that they don't have any unethical practices in their background. And that concludes our discussion of internal control structures. The question that we have for this objective is, a good system of internal controls accomplishes what broad objectives for a business? In Objective 6, we will discuss the inherent limitations of internal controls. The primary limitations of internal controls consist of human errors, which is basically ensuring good hiring practices and then training and properly supervising your employees to hopefully minimize human errors. Collusion. This is when two or more people might work together to defraud a business. And third is changing business conditions, such as technology changes or economic changes that are taking place in the economy. These may impact the business and limit the internal controls. Businesses must do a cost-benefit analysis of existing versus new procedures to address changing business conditions. In Objective 7, we will discuss applying internal control activities that are common in merchandising transactions. Sound internal controls in a merchandising business are established to prevent theft and promote accuracy. Management goals and internal controls are really to prevent losses of either cash or inventory and provide accurate recording of transactions and account balances. Additional goals are to keep enough inventory on hand to allow customers to purchase their merchandise without overstocking inventory. Additionally, management wants to keep enough cash on hand to pay for purchases and be able to use discounts to reduce the amount that they're paying for their purchases. And then lastly is to try to keep credit losses low by ensuring that customers pay on time. Some controls that management can put in place to meet its goals are, first, to establish a cash budget. Projecting receipts and cash disbursements will help ensure businesses have sufficient funds when needed and excess money is properly invested. Additionally, again, management wants to establish separation of duties. Establishing separate functions can protect the business, its assets, and its personnel. Lastly, they should control cash. Receipts of cash should be recorded immediately in the journal with written records of cash receipts. Cash received through the mail should be handled by at least 2 employees. Again, going back to that separation of duties. And then lastly, cash received over the counter should be used or recorded through a cash register with pre-numbered sales tickets and transactions handled on time. Additional forms of internal control relating to making purchases within a merchandising business include the following. You can see examples of these exact documents on pages 302 and 303 in your textbook. So first, when making purchases, a purchase requisition should be put in place. This is just simply a request for purchase by whomever within the organization is looking to make that purchase. Second, a purchase order should be written out or prepared. This is addressed to the vendor with a description of the product to be ordered. Third, an invoice or bill should be received with the order. That invoice or bill should be properly processed throughout the organization. A receiving report should be prepared by whomever is in the receiving department, describing the items that were received from the order. The fifth item is check authorizations. Accounting completes and attaches the supporting documents to send to the Treasury Department to ensure that a check that is issued for the payment to the vendor is has the proper information. And then lastly, the actual check itself is prepared. The check is prepared and signed in the Treasury Department, and that's just simply an order for the bank to pay the vendor. And that concludes our discussion for Objective 7. And so, name the documents needed for an internal control plan for purchases and cash disbursements within a merchandising organization. And that concludes our notes for the Objectives 5, 6, and 7 of Chapter 6, Merchandising Operations and Internal Controls. Please proceed to the next slide to answer review questions related to Chapter 6, Objectives 5, 6, and 7. Please complete the following questions and click the Submit button to send your answers or responses in. Thank you.